Hi, everyone. Welcome to another episode of the Latam Stocks Podcast. I'm your host, Patrick Flood. Today, I'm speaking with Lucas Queiroz. Lucas is a fixed income strategist at Itaú, one of the largest banks in Brazil. He publishes a widely read research report called the Carta do Estrategista about Brazilian fixed income markets. So we're going to talk a lot about Brazilian treasuries, fixed income, some of his current market views. So it's going to be an interesting conversation. I'm excited for it. Hi, Lucas. How are you?
Hi, Patrick. It's a pleasure to be here. Thank you for the opportunity.
I really appreciate you taking the time to do this. So before we get into the fixed income and your work at Itaú currently, can you tell me a little bit more about yourself? Where are you from? Where'd you go to school? What did you do before you worked at Itaú in fixed income?
Oh, yeah. I'm 34, but I have a long story. Let's put in a short. I'm from the state of Minas Gerais, which is best known for mining and steel industry. I was born in the capital, Belo Horizonte, one of the largest cities in the country, with nearly 6 million people in its metropolitan region. But it's located in the southeastern region of Brazil, similar to Rio or São Paulo, renowned cities by foreigners. I completed my undergraduate degree in economics at the University of Minas Gerais, the Federal University of Minas Gerais, and back then was somewhat surprising to some people because I didn't personally know an economist and had no relatives in the field. It was a path I had to navigate on my own. And even before joining the course, I had decided that I wanted to work in the financial market because it was very interesting to me. I wanted to follow the news and understand what is going on outside. So I had no doubts was economics and financial market. And I had already taken a course on stock market investment, about graphs, about technical analysis, and before joining the course. I was the beginning of 2008, and with the economy experienced several positive years in a row. Brazil was facing a huge moment, and the capital market received a boost, and there began to be a supply of investment courses for retail clients. Well, wasn't something that you could find easily, but back then was growing, and I took a course, and wow, it was really, I decided that was what I really wanted to do. Following year, I started the course and soon began an internship to provide context. The financial markets in Brazil, and I know your audience is formed by foreigners, is highly concentrated in São Paulo, and I was in Belo Horizonte. And in São Paulo, there is a significant number of job opportunities and a lot of banks, asset managers, but my region, there was steel and mining industry, so not a bank hub. So was something more difficult, and I started at a brokerage firm, and I started in back office. And it's very common to start in back office here, and you are stepping higher and go to the desk, and this is my story. And a year later, I moved to another brokerage firm, but this time I already actively worked as a broker, trading stocks and some derivatives and coffee. It was one of the products in my region is well known, so was an important product. I worked as a credit analyst in an investment fund, and when I was nearing the end of my undergrad, I decided that I need to pursue a master's degree. I felt I wasn't prepared in terms of statistical modeling and economic theory to apply to be an economist. And I decided I had to go to the masters. And I did my masters at the Federal University of Rio Grande do Sul. So I moved to the southern region of Brazil, near Uruguay, Argentina. And what attracted me there was that master's program there was highly focused on quantitative method and econometrics. And some topics I knew I had to improve. What I didn't expect was to find a professor who had been a fixed income and derivatives trader. And he ended up introducing me to this universe. I ended up enjoying it, wrote my dissertation on yield curve modeling, and have been delving deeper into and studying the subject since then, about 10 years. Almost 10 years.
Okay. Yeah. So the yield curve stuff, I definitely see that kind of work in your publication. I definitely notice you're doing yield curve modeling in your publication. So it definitely shows.
Yeah. And my career goes in that direction. After completing my master's, I returned to Belo Horizonte and joined a pension fund as an analyst. There I gained deeper understanding of how long-term investor thinks. It's very important because focusing on structural allocations, constructing an investment portfolio with many asset classes, it was crucial. Learning experience was very important to me, even after when a year later an opportunity arose at an asset managed firm, still in Belo Horizonte, was a medium-sized hedge fund, and I accepted because I wanted an experience more dynamic, more high-frequency trading. I want to experience this side. And again, very important for me. I really recommend that you can, if you can, have this opportunity to take many views. Long-term investors, short-term investors, it's very important to understand how things work, how the machine works, because if you have only one view, sometimes you don't understand, why the market is going that way. And when you have the whole view, it's very important. And this time when I was at an asset manager, leads me to the development of other skills. I think resilience being perhaps the most important. And there I started working at corporate credit strategist. I was an analyst of credit, conducting both credit analysis and trading. And it wasn't the real area I was most interested in, and I've been there. And 1 year later, another opportunity there in the same asset manager. I transitioned to a portfolio manager position and focusing more on fixed income, currency, and it was what I've been dreaming about since when I was at my master's. So I employed a top-down macro approach, and I'm an economist. I apply economic theory. I analyze the whole economy, and I have some systematic tools. Even not being a quantitative trader, it's very important to combine economic theory and express some views in a systematic trading system. And it's very important in Brazil because the volatile environment here sometimes get you lost. You being confused because I was planning to do something, and a lot of news and can be very dangerous to your view. So
tell me a little bit more about your work today at Itaú. So let's talk a little about the Carta do Estrategista. I know all the things. You can see your background in the publication with the analysis and then the top-down view. So can you just talk a little bit about what is the publication? Who's the target reader? What kind of fixed income do you cover?
Yeah. Taking a step back, Itaú is the largest private bank in Latin America, and with an impressive coverage of the region, and have operations in many countries and the major countries of the region. And I'm at the research department of the bank, focusing on advising institutional investors. Institutional investor and retail investors. Let's take a step back, because I think it's very good to get the whole view. For many years, the distribution of investments for individual clients was limited to the account manager at a bank branch. So you go there, you talk to your manager, and you can take a credit card, or you can take an investment, the whole thing. And this professional was responsible for assisting with many things, but nothing with depth. So he only could handle it because the client don't have a depth demand. So
they didn't know what to ask for, so whatever he was selling, the client would just kind of take.
It was something very superficial. Clients mostly sought short-term post-fixed income securities and float rates, and for many years it had substantially returns above inflation. So very good, and the manager didn't know to delve deeper in this side, and it was a market in Brazil until, I guess, 2011, 12. And the cycle of falling Selic, the Selic is our base rate, from 2016 to the COVID era, was transformational for us, because it was the first time investors saw the returns on these products compressing, leading to a demand to more sophisticated products. And in response, the bank now has nearly 2,000 financial advisors, not only a manager, a banking manager. So we have 2,000 financial advisors, and my main task is to develop investment scenarios in fixed income based on our projected economic scenario. We have a huge team, a huge economic team, and I have to connect the dots. And they give me a scenario, we discuss it, and I have to transform it into strategies in fixed income markets. And there is another difficulty here, and we have to be more like I can't say, we say in Portuguese, economist. I don't know how to say it in English. We have to a more plain language, not something
less jargon, more clearly spoken. Explain things clearly to retail clients, because they don't understand the economic terms.
It's another task. The goal is to equip these advisors and internal bank departments. Working on the sell side is new for me, accustomed to taking risk in investment funds, but it has been a great experience, and giving the ability to influence a large number of people and interact with a large and multidisciplinary team. We talk about equities, retail, real estate, fixed income, and a lot of sectors in our economy. It is a very good position. And in this structure, the target client is the bank's internal audience, and indirectly, the bank's more than 60 million customers. A large number. We have also received positive feedback from institutional clients, like some hedge fund managers, especially in São Paulo. The research department has a corporate credit analysis, and they are responsible for analyzing issuance available to investors. It's a micro level analysis, so modeling the company balance sheets and understanding their debt repayment capacity. So what I do is a bit different and complementary because my perspective is macro. So I seek to understand, given the scenario, the best segment to position oneself on the yield curve, whether the best option is fixed rate, post-fixed, or inflation-linked bonds. So the most common here in Brazil is float rates. I guess we will talk it later in the conversation, but there's some difference for in Brazil from the US, for example. The fixed rate is the most common instrument there,
so let's get into that. Let's get into that because I think what you cover is the most important investment market in Brazil. Like you mentioned, most retail clients. It was short-term fixed income for a long time. The Brazilian Treasury market is what most Brazilian investors allocate to. So can you talk about some of the most popular instruments like Selic, the prefixado, post-fixado, like you mentioned? What are some of the most popular investments in fixed income in Brazil? And then what are some of the differences between the instruments?
Yeah, the Selic rate is like a Fed funds rate. So it's an overnight rate, and we have a lot of products derived from this. Looking at the capital market, for example, the government is the issuer of 51% of the fixed income securities in Brazil. This information is from October, I guess. It's the last information released. Among other reasons, due to state's ability to issue the currency and extract resources from the productive sector through taxation. So it's well known as the lowest credit risk in the country, as every other country. The remaining 49% of fixed income securities were divided among private issuers. But these 49 bank issued securities account for about 7% of this total. And it's very relevant because you have the government that is huge, and
51,
you have the bank, 51, and you have the bank industry that is 7% of this 49. So you basically our fixed income market is to lend to the government and lend to the banks that they can lend to other people. And why is that? Because we have an economy with we have a high volatile economy, so banks can do it better than anyone else. So it's why the share is very big. And going forward, what do you think about? Oh, it will compress. It will go lower because when you have a more stable economy, look at the U.S. You have a more stable economy. You have inflation. Look, U.S. before the COVID era, and stable inflation. You can take a fixed rate instrument because you know what will be the inflation, so you know what will be your return above inflation, and you can go into fixed rate instruments. Brazil, no. You have 10% 1 year, 5 in the following year, and it went lower to 3, and yeah, it's a very volatile environment. We have a target, an inflation target now about 3.3%. The market don't agree with it and thinks the inflation, the average inflation will be 3.5, but the official target is 3. And if you look at the past, the average was about 4 to 5, 5 to 6, something between these numbers. The average is 4.5, for example, but you have in the last 10 to 15 years, many times where inflation went to 10%.
15 or 16, right?
Not just, not, yeah.
Sorry, go ahead.
And 2016 or 15, I don't know, and the COVID, but we have many times, not these two. And what Americans are experiencing today is something we are used to.
Right,
And
yeah.
it's very. What is happening in US today? Oh, people are moving their investment from fixed income in the long term to short term. Because what? Short term is paying their 5, I guess, a little bit more than 5% per year. So why you take this risk in a volatile long term yield curve? So it's the history of Brazil. So we are used to it, and because of that, our central bank has moved really well this period, and it was emphasized from many magazines, journal, and something like that. And you did the right thing. You raised rates when every other central banks was discussing if the inflation was temporary or not, and our central bank raised rates because
they know inflation.
We know how to navigate this scenario, and it's our difference.
Right.
We was raised in this environment. It's very common to us. And
so does that historical volatility then that you talked about, like the unpredictability of inflation, does that mean that most fixed income investors in Brazil prefer floating rates opposed to fixed rates?
Yeah.
And it's usually linked to what?
Sure.
To Selic, or maybe I don't think a lot of listeners understand what like a CD or a EPCI.
Yeah, it's the same.
Linked is. So yeah.
CDI is the same as Selic, but Selic is when banks transact, and CDI is like, they transact with public bonds, and when they transact without public bonds, it forms the CDI, but it's the same rate, and the number is the same, and many investments are related to these names, CDI, and especially CDI, and people prefer float rates because they don't want to take the mark-to-market risk and don't want to extend their duration. So float rates and duration about 1 day, because you can get your investment.
You talk about Americans. Tomorrow. Talk about Americans learning, the Brazilian lessons. You guys understand the mark-to-market risk is what blew up Silicon Valley Bank, right? They didn't understand duration of mark-to-market risk, and the average retail investor in Brazil understands that. That's why they're sitting in short-term fixed income.
Because didn't navigate this scenario, so just a lot in the past, and we are used to it. It's very important to understand Brazil. You have to understand our roots, inflationary roots. And it was very important in the past, and people know it and are afraid of many things that happening in the past. And investors here are very conservative, and they don't want to take in volatile investments, don't want mark-to-market risks. And it's been a problem because when rates went to 2% in 2021, I guess, because the COVID, many people look at their investment and say, "Wow, we can't even pay the inflation. How I can handle it?" And they moved their investments to more aggressive investment. So they bought
equities.
stocks.
Did they move out the yield curve as well? Did they stay with fixed income and start going towards lower rated?
Yeah, they started buying fixed rate investment, not fixed. They are buying fixed investment now, and I don't think, and I don't know how it will be in the future. But that time they bought a lot of equities and long-term bonds because short-term wasn't paying much, and they started buying long-term bonds. And moving fast forward to today, now the rates have raised, and wow, a lot of losses. And people, I couldn't buy these investments, and I did it in the past, was a mess, and they back to short-term investments. And so I guess from now it will change, but this time people have a lot of short-term investment, float rates, and one of the reasons our stock market is doing so bad because there is no one to buy it, and it's very difficult.
I was going to ask you exactly that. So unlike the COVID cuts, in this current rate cut cycle, which has been going on for a few months now, you still haven't seen the fixed income investors start to move out the risk curve into equities or longer term duration or higher credit risk like they did in COVID. They're still so far at 12+%. Are they still content with the real yield on Selic?
I didn't get your question. No, please repeat.
So this cycle, we've seen rate cuts for the past few months, and they've started cutting. Have fixed income investors started to move out the risk curve like they did with the COVID rate cut cycle, or are real yields still attractive enough that they'll sit and they're still just leaving their money in Selic?
I can say investors are more into fixed rate now, and if you have a fixed rate investment, you can sell it easily. But how can I say? People are not moving to equities, and I think it will last for a couple of months because our rate is getting lower, but wow, it's in a high level. It's still a high level. So people don't understand that it will get lower in the future. They understand what they see at the news. So the Selic now it's above 12%. So people see it. They don't know.
Some investors have been willing to lock in that fixed rate at 12 or 13%, and they say, this is high enough, I'll go out the duration and I'll take 13%.
Yeah. It's interesting enough to hold a fixed rate investment, but it's not interesting to enter into equities. It's a vision for many investors.
Right.
And I think will change. 6 months in the future, I think it will change. We will have a Selic about 9%, and wow, maybe investors will look different to the market.
So in your report, you do some modeling for the cutting cycle. And so is 9% where you expect the central bank to end this rate cut cycle? And how long do you think that will take? Because I know the market expects more cuts. So Maybe how many and how fast do you expect?
Yeah, I get this input from our macro team. So they expect the terminal rate to be 9.5% in the middle of in the next year. And what I do is to get this input, and what is my output is, well, with 9.5%, how would it look the long term? So looking at the long term, when the short term be at 9.5, I think long term will be at 10.5 to 11. And
Okay.
with an inflation running about 4%.
So even at 9.5,
a very interesting rate.
It's still a very interesting real yield relative to the rest of the world, right? Brazil right now has some of the highest real yields in the world. And even at the end of this rate cut cycle, it sounds like you're expecting Brazil to still have pretty attractive real yields.
Yeah, why is the main question? Why? Well, because while we are facing some positive news in the inflation front and this week from the external scenario, we are facing a more tough discussion in Brazilian, our capital, on the Senate, on the Congress, and about our fiscal rule.
Mm-hmm.
We have changed the fiscal rule this year. It will prevail next year, and it's not, how can I say, it has could face a lot of problems next year. And investors are very afraid about our debt. And it's interesting because US is facing too. And talking about Brazil with foreigners, they say, well, it's not a problem. We are facing something very bad too, and it's not an issue now because every country is facing the same. But we are afraid because it's a problem that we never address it. And so we are afraid that this time will not be different, and our debt will rise. And yeah, it's something that always in Brazil was a problem. So we are very afraid about the debt and the debt path. And yeah, it's the reason people think the central bank will not go lower. So the market thinks the neutral rate is 8.5. So would be natural to expect that in a recession that can be in the future, the rates go lower than the 8.5, but markets are afraid of the fiscal situation, and they are pushing to 9.5 the terminal rate. Everything can change in the future if US enter into a recession, if the economy in Brazil do worse than we expect, and the rates can go lower, but it's not the base case now.
Okay. So one of the other things I really liked in your research report is that you put out a preference map for specific Treasury issuances that I like, because I don't see much research like that at all, actually comparing and contrasting the different Selic rates and everything. So I don't know if maybe you could talk about one of the specific issues you're favorable on, because you rank them as pessimistic, neutral, and optimistic. So is there an optimistic issue or a pessimistic issue you think is interesting to talk about?
Yeah, I'm not pessimistic with nothing.
Yep.
In the fixed income universe, last report, and last report was about 1 week ago. And what I'm optimistic now is about fixed rate in the long term. I want to navigate this scenario because we are facing a positive scenario for inflation. Inflation it's doing much better than we could thought some months ago, and especially in the service sector, there is a more difficult to sector that monetary policy uh, can fight. It's the worst enemy, and it's doing much better than we have thought. And why? Because we are seeing activity is not doing very well, and well, it can be a acceleration in front of us. And I'm very positive about inflation, so I'm very positive about fixed rate investments because our implied inflation is very high. For 10 years, it's above 5%. I guess it's about 5.2% per year. It's very high because we have an official target of 3. Even market is agreeing with the central bank. They think the central bank will deliver 3.5. So yeah, we have implied 5.2, and there is juice, and I think it will be compressed the following weeks. So I'm very positive about fixed income, but this is a tactical allocation, okay? Because I'm looking it for next month, for next week, and I'm looking how things will play out. What I'm structurally positive, and I'm not optimistic for the short term, but I'm optimistic for the long term. Is long term investments in inflation linked bonds in Brazil. They are offering about inflation plus 6 and sovereign bonds, and it's very good. And our neutral rate are about 4.5 to 5, and above inflation. So if you receive inflation plus 6 without credit risk, it seems very good. And in Brazil, we have some investments that are tax free, and they are corporate credit directed to infrastructure, and are tax free, so they are paying inflation plus 7, 6.5, and tax free. Seems one of the best instruments in Brazil right now, and I'm very positive. If you want to make a portfolio and want to hold it for a while, and I think would be one of the best returns after all.
Yeah, that's really interesting. I talked to Frederico Nobri a few weeks ago, and he talked about the Petro Rio had an EPCA plus 7 that was tax free, and he's okay. Yeah, he said the same thing basically. He said we saw that and he loved it. So
how you can fight it with stocks? It's very difficult for an equity guy to look at this scenario and say, well, what I can offer to my client, and imagine an equities portfolio manager. He looks at it and whoa.
It's been. I posted today too. It's
difficult to
been
do that.
Such a hard year for the equity guys in Brazil because Petrobras is pulling up the Bovespa, right? So if you're benchmarked to the Bovespa and you didn't own Petrobras, everybody's underperforming. It's a brutal year to be benchmarked to the Bovespa.
it's very hard to navigate scenarios of raising interest rates in Brazil, and when they are raising and when they are higher. When they are high, it's still very difficult, and things looks much better when they are falling and falling in a rapid pace, on a fast pace.
Okay.
So I think it can be the scenario some months in the future. I think if the inflation doing very well, external scenario improving, can be a case for our central bank to increase the cuts. Let's see.
Lucas, that was a
Will
great
be very good
conversation.
for other asset classes.
I got through my questions, so I don't know, is there anything else related to fixed income, anything else on your mind that you think might be interesting for an international audience about Brazilian fixed income?
The main point the international audience should know to understand Brazil, and especially the investors in Brazil, is that you were raised into an inflationary scenario. So we are afraid of inflation. So investors are conservative in Brazil, especially about inflation. It is the first thing to notice. Other thing to note is why we are a fixed income country, if I can say it.
Yeah.
Because of that, and there is another important consideration: how we evaluate companies. We need to discount for a rate, and our long-term rate is very volatile. So it poses equities to be very volatile, not due to company-related factors, but due to fixed income factors. And it's the question. It's one of the questions. It's one of the reasons. That small caps in US are doing bad.
Yep.
Because rates went up, and it happens in Brazil. 3 to 5 years, it's a cycle, and we have to raise rates, and stocks go lower, and after rates go lower, stocks went up, and it's our cycle, and I think it will happen again, and when rates come to 9%, for example, investors will be more optimistic about equities or real estate funds and something like that. And in fixed income, we still have a lot of opportunities, and it's very important. I think we will be paying maybe not inflation plus 6, but inflation plus 5, and it's still a good deal.
So it sounds like the 60-40 portfolio still works in Brazil. Is that kind of what I'm understanding? Is like the right, because there's a lot of talk in the U.S. The 60-40 portfolio died.
No. There is a difference. There is a difference from Brazil to U.S. When things are going pretty well in U.S. rates. How can I say rates go up, and when things are doing pretty well in Brazil, rates go down in Brazil, because we have a lot of risk premium embedded into rates. So this is different, because in US, when things are doing well, stocks go up, but rates go up too. So the fixed income bond, you have some loss, but you earn into stocks. In Brazil, no, it's the same. When things are doing well, you win into stocks or long-term fixed rates, and you can't have the two in your basket. So
That's really interesting.
640 don't work in Brazil.
That's really interesting. Lucas, thank you so much for doing this. Where can people follow you and read your publication and get in touch if they want to learn more?
I've been publishing my report, my monthly report, at my LinkedIn and through the bank for our clients. But LinkedIn, I'm always posting a monthly letter.
Great, and I'll put the link to that in the show notes for anyone that's interested. Thanks so much for doing this.
Thank you.
Thank
you.